We're live on all sorts of channels going on right now, so let's get ourselves cracking. There's my little start of a 10, and I think we're good to go, ready for a great session today. So welcome everybody. So boom, let's get me back on the screen and all those good things. I hope everybody is well. I hope you're well. I hope you're preparing yourself for Christmas, and you probably are. You may well have stopped working. That's fine. You might have given up for the year. A lot of people have, actually. You can tell by the street outside. Everyone's parked up outside their houses. It's a terrace street, this one. There's no parking spaces, so everybody's at home. But I think everybody's working from home anyway, because that's like the latest rule, isn't it? And have we locked down? I don't know. Have we locked down? I think we are, but I'm not quite sure what's going on half the time. But Christmas is upon us, and I'm really looking forward to it. So this is my last live stream with you this year, and we'll pick up again in the new year when we can do, if we can, of course. We'll see how the world turns out, but we're virtual. We're down here in Tivoli Studios, so we'll be able to broadcast to you and talk to you about all those good things as we continue. So what have I got planned for you this afternoon for about 15 minutes or so? I've got a couple of great ideas to help you to understand the mortgage world and what's going on and things like that, some updates and stuff like that. But it's all about dinner party conversations. That's what I want to focus on. Imagine you're at a dinner party around Christmas. It could be the big day itself, the big meal, and conversations drying up a bit, and you want to maybe have a bit of an intelligent conversation. So I got some ideas for you there as well. But first of all, what's your year been like? It's been a hell of a year, isn't it? 2021. Who'd ever have thought this like years ago? You'd have foreseen this. It's been a crazy year for everybody, really, whatever your sector. For the mortgage sector, it's been a very busy year, much of it fueled by government subsidy called stamp duty, well, a lack of stamp duty for a few months as well, and a lot of brokers getting into the business and having a good time. So it's been great for the sector. The world, of course, has gone completely and utterly crazy. What about 2022? Well, that's up to you. I'm sure you're setting yourself some goals. We've got a goal setting session I'm running actually early in the new year called Achievement Goals for Mortgage Advisors. So it's about an hour, and it's some crackingly good stuff to help you set your goals. So I've got that coming up in the new year, and we've emailed everybody on the database about that. So if you didn't get the email, then get on the database is the key thing. They'll just ping me an email and I'll get you have details of that. That should be really good, actually. But where's your 2022 going? Well, you can try and plan it. But of course, there's this big thing called COVID that gets in the way, doesn't it? It seems to anyway. So you need to be able to plan yourself, because at least if you've got a plan, you'll be able to like alter the plan if you have to because of COVID. If you haven't got a plan in the first place, then you can't alter anything, can you? So you just be what we call faffing around, which is one way of putting it. But the pandemic is still there. We did think at some point this autumn it was becoming an epidemic. In other words, ravaging in certain countries around the world, but not worldwide. But it still seems to be worldwide with Omicron, or whatever they like to call it. And that's probably not going to go away, actually, thinking about it, moving forward. I mean, pathogens is what we get, obviously, from animals. That's going to probably increase as time goes on. We're closer to animals than ever before. Not like dogs and cats. I mean, we're closer, the world is closer to wet fish markets, wet animal markets, all those sort of good things around the world, which tend to get us close to animals. So, you know, it may well be something we have to live with for a long, long time. So plan your goals and make sure that they are flexible is the key. You like that little bit there, did you? Anyway, you might well be putting your feet up right now. You might be a Monday on your first day off after like no holiday at all. You might be already reaching for the nuts and the biscuits and things like that. I'm sure you're not. I'm sure you're working, or at least getting some exercise anyway. So let me get on to dinner party. Sure, let's get on to dinner party topics. So I'm going to go over to the whiteboard for this one because I can really, and I want to. So I want to go to the whiteboard, just give you some ideas about dinner party conversations. And I'm not saying that you should be a bore and start talking about mortgages and financial services. Well, you can do if you want to, but say somebody, great Uncle Albert, for example, asks a question about your new job and maybe tries to catch you out. You've got some answers. So there's 4 areas I want to take a look at for you that you might want to use to start up a dinner party conversation. So let's just take a look at this one. So I don't say, for example, you're onto your pudding, and you want to be intelligent, and you want to maybe throw a question to everybody and tell people what's going on. Now, the first topic you might think about is what I call the insurance companies. Insurers, there we go. Now, you probably heard about this in the press, but the FCA, by the way, FCA, well done for doing this, by the way. This is a good move you made here. The insurers have no longer going to have the I don't know what they've done is right or wrong, really. I think it's a bit naughty what they've done. But as you know, of course, it's new customers only kind of thing, because they have for years used websites to attract new people and given you strikingly good deals on your insurance. We're talking about general insurance, car insurance, travel insurance, that kind of stuff. The stuff that's renewed every year. And people tend to switch around and have very little loyalty, because that's been created by the fact that insurers are able to offer much lower rates to new people, but existing customers they're offering higher rates. But what they've done now, what the FCA has said, is that insurers have to offer the same rates to everybody, whether you are a new customer or an existing customer that's renewing. You have to have the same rates, and that's coming through in January 2022. And I think that's a good thing. Oh, Martin Lewis won't probably have a lot to talk about now in his annual show, or weekly show that he does, because all he talks about is switching, doesn't he? That seems to be his favourite word. But it's true. Up to now, of course, it would be useful. But loyalty now is going to pay off dividends. If you're loyal to an insurance company for your car insurance or house insurance or whatever, then that you will be offered really good rates, because they are legally not allowed to offer cheap rates to new people to lure them in, which is a bit of a marketing game, really, isn't it? It's not right what they've done. These big firms, they kind of get away with this. It's not a monopoly. I get all that, but it's a bit like OPEC, really, isn't it? All these sort of cartels that are going on. But that's gone. Love that one to bits. So you might want to mention that one to please everybody. They don't have to start strong now. Second one for you then is interest rates. Rates, of course. We know this. I'm not going to talk about this because the whole world has reported this, isn't it? But the Bank of England base rate is now 0.25%, I think. Bank of England. There you go. That was announced last week. And that wasn't unexpected. But people said it was, but actually it wasn't. It was muted months ago when the short-term gilt market started to rocket, and the government said the interest rates are going to go up to control, of course, inflation. Because inflation, the CPI, which we use to measure inflation, is about 1.1% or something like that. Google the latest rate. But that's pretty bad, really. That's not good. That's not been that high for donkey's years. And in the States, of course, it's even higher. Inflation's starting to rise for various reasons. The main reason is that suppliers have been bottlenecked, haven't they? A bit like a tomato sauce bottle, isn't it? When you're trying to pump out the tomato sauce out of the bottle, and eventually after a good old thump, it comes blurting out. That's what's happened to supply chains around the world. They've got stuck pretty much. They're starting to loosen up, but I think the latest Omicron might well take care of that, and it might cause even more problems. Because think about it, Omicron seems to be devastating highly populated areas like London. New York's been rampant with Omicron as well, or Omicron, however you pronounce it. So some of the Far East areas, which are densely populated cities, they may well be hard hit by this. And of course, that's where we get a lot of our goods from. So could see some supply problems, but the pump prices are coming down. Don't know if you noticed, fuel's come down to about 140 a litre now, down from about 150. Fuel affects everything. Saw that over the weekend, because that might tame inflation slightly, but we'll see how that pans out. But if we have a lockdown and restaurants and bars have to close again, they'll reopen again in the spring with increased prices, because they do. And the old Airbnbs and UK holiday prices will probably double again, because they can. And it's like a cartel there as well, really, at the end of the day. Not into cartels at the moment, like informal monopolies. That's what they are. So we might see inflation drop, but the point is that interest rates have gone up to try and combat that. That's the point. And that may have an effect. It may not have an effect, but the Bank of England have done it. Will it affect mortgages? Of course it will. Lenders like to have their little margins, don't they? Or big fat margins, and they've already increased rates across the board, left, right and centre. We might see some more rates rises next year, but it's not going to massively increase, which brings us on to the next topic, which not a lot of people know about this one. So let's get a different colour pen. Let's get a red pen for this one, because this is an alarming colour, isn't it? We're talking here about stress rates. Here we go. Now, you probably read about the Bank of England policy committee guys and girls are getting together to talk about this business about stress rates. Now, the stress interest rate, is what we're talking about here, is used to help calculate somebody's maximum affordability for a mortgage. Has done since 2014, when we had the new rules came in to try and prevent people borrowing too much money that they couldn't afford to pay back, which is a good thing. But it was a bit like horse bolted afterwards kind of thing, because interest rates have come down so low that people could suddenly afford larger mortgages quite easily. But they worry about interest rates going up. Hence, they put a stress rate against your affordability. So rather than charging at normal rates that they are now, say 0.5%, 1%, 2%, because that's what you pay, rather than working out what you can afford on that rate, they work it out on a higher rate, sometimes 4, 5, 6%, which means you can't borrow so much. Now, they're looking at getting rid of that. That's a big issue, that one. They're looking at getting rid of that or reducing the stress rate dramatically downwards. And what that will mean, of course, is that people can have bigger mortgages. Obviously, there's also the loan to value issue about deposits and stuff, but bigger mortgages. What that means is that first-time buyers who are struggling to get on the housing market because they can't. Okay, they've got a better deposit, don't need so much deposit now because of government incentives and things, but the fact is they still need to borrow a large amount of mortgage. And based on their current incomes, which haven't really budged in the last 10 years because wage inflation hasn't really gone up, people are able now to borrow more. So you wait to the impact of this next year. I mean, the first-time buyers can borrow more money, fix it for 5 years, so they don't have to worry about interest rates going up, and therefore they can buy these houses. And that might have a really good effect on the housing market. First-time buyers will want to be able to buy the houses again that landlords have been snapping up, and that will really boost the housing market nicely. Well, we'll see how things pan out. Good for mortgage brokers, of course, first-time buyers, great people to deal with. Often they tend to go to high street lenders who will be coming in next year with their apps to try and soak up that demand. But if you're a mortgage broker and you're linked to an estate agency or somebody like that, you should be able to make some hay whilst the sun shines. So that's a really good change. Okay, what about the last dinner party topic for you as well? It's money again. Government spending is the big one here. Government spending. Now, the government that we have at the moment, love them or hate them, I'm not going to go there on that one. There's enough people trying to cause all sorts of aggro with politics. But the point is, though, that the government operates a monetarist economic policy, which means they use interest rates and stuff like that to control the economy. But there is a lot of spending going on. Now, the big issue about spending, of course, is COVID. COVID costs a lot of money. It has done £300 million, £1 billion, so you get the right figure there. It's a lot of cash. They've used it on furloughs and bounce back loans, all sorts of things. They may have to pay some more. If we do have another lockdown or small lockdown or circuit breaker or whatever, the restaurants are already squeaking, bars, etc. They already want money. And fair play, because they've lost their living. Can you imagine running a restaurant and you've had a really torrid year, and then you had a decent enough summer, autumn was okay, and then you got this Christmas run up. You're really hoping to get some good business in, so you spend money on the place, you make it look great, you get loads of bookings, pre-Christmas parties, etc. Then literally early December, this thing about Omicron comes out, and you get cancellation after cancellation. The phone's ringing all the time, and every time it rings, somebody's cancelling. Can you imagine how you feel? That's not good to go through that stress just before Christmas. So you can understand where they're coming from. But the thing is, who pays for all this? That's the question. Who pays for the money that the government are using to spend at the moment? Okay, you could argue that taxes pay for it, and they have increased taxation in a kind of a stealth way, haven't they? Left, right, and centre. And they've got this new sort of health and welfare tax next year and all sorts of things. They have increased taxation, and it's the highest since the Second World War, or something ridiculous like that. But it's not that bad, and it can't pay for everything. It's QE, of course, as you know, quantitative easing. Now, QE, for all intents and purposes, is printing money. It's digital money. It's not real cash. It's digital money. And the Bank of England put it in their bank account, and they buy bonds with it, and that's been going on for a long time. It's stopping now because interest rates, you see, inflation's going up. Now, inflation goes up, they therefore need to stop QE and start increasing interest rates. It's all about money supply. It's all about expanding the money supply when you want a big boost to the economy. And they've done that by reducing interest rates, which didn't have much effect. So they've printed money, which expanded the money supply. That's all, simple as that. Now, inflation's starting to get out of control, so they're squeezing the money supply now. They're contracting the amount of cash in the system. They do that by stopping QE, increase interest rates, which stop bank lending and stop movement of capital. It's that simple, really. So QE is going. So who's going to pay for all this government spending? I don't think they're going to do it this time, is the thing, because they haven't got this magic money tree anymore. So that might cause a few problems. Maybe if we have a real COVID issue next year, it might dampen the economy again, which might bring down inflation, and therefore they might be able to reduce interest rates and start QEing again. But don't look for Rishi to come out with the flags this time. Spend, 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 because he ain't got the ability to spend anymore now. He's got to be able to borrow money now in the old-fashioned way, sell those bonds to the market, and the market may not want to buy them. If they do, there'll be higher interest rates. So lots of things going on. So that's the other one. Who pays for all this? Well, we've paid it basically by printing money, or the government paid it by printing money. It'd be great if you could just print money. Actually, that's illegal, isn't it? I think in certain countries, this country as well, to print money. But there we are. So there's some dinner party ideas for you. I hope you like that one. It's a bit of fun, a bit tongue-in-cheek, really, isn't it, at the end of the day? I'm not expecting you to have those kind of conversations at dinner. Usually the jokes and the crack are good enough, aren't they, to sort of get a conversation going. So where's 2022 going for us? Well, we've got some exciting plans next year. We're continuing to deliver via Tivoli Studios, and this real-time live streamy kind of video stuff really works. We're doing a lot of corporate work next year for corporate teams, teaching corporate teams how to present using video as well, rather than sit in front of the laptop. We're going to get them to actually present as well. So we're going to do a lot of teaching around that as well. A lot of sales skills, a lot of communication skills to all sorts of mortgage broker teams as well. For you guys individually, we've got all of our boot camps, of course, which are self-contained video courses. We've got the CMAP boot camp, the protection exam boot camp, and the equity release exam boot camp. These are things that mortgage brokers need. You need CMAPs, of course, you need a protection exam, and you need an equity release exam. We'll do the weekly stuff as well, because that keeps you up to date with CPD as well. So we'll do those for you, which are available on the database. We keep you informed of those as well. We've also got the Skills Academy, which we've done a couple of times this year, and we're going to launch that again in February, which involves lots of skills teaching. So if you've joined the business and you've got your CMAPs and you're finding it a bit tricky to get things going, you know, prospecting for business, running a sales process, that sort of thing, it's not quite happening for you. If you want to invest a bit of your money, you can get some crackingly good training to help you to achieve more, to communicate better with clients and to sell more mortgages. So we've got that coming up as well. We've also got some supervisory role play stuff. The FCA are on firms at the moment wanting you to coach your people more. So we're going to be teaching firms how to coach first, but we've also got the ability to coach your people directly when you want to, or if you want to be coached further on the selling skills, then you can come to us for that as well. So lots of stuff happening, really excited about 2022. It'll be a good year. Christmas, yeah, we're clocking off on Wednesday, so looking forward to a few days off. We've got family coming around, if we're allowed. I think we will be. But anyway, I don't think they're going to put any draconian measures this side of Christmas, but who knows, eh? Maybe next week they might do that. So we're looking forward to Christmas, have some good eats, something to drink, have some fun, all those good things, what Christmas is all about, isn't it? And we'll see you guys in the new year. So have a happy Christmas, have a happy new year, or is it happy Christmas and a great new year? No, Merry Christmas and Happy New Year. So whatever you like to celebrate at Christmas, it's the holiday period, really, isn't it? At the end of the day, not everybody does Christmas, I get all that, but we love all the holidays and things that go with it. Anyway, I've talked enough this year. I'll see you all next year. Take care all. Bye.